Let's kick things off for today. Welcome back to another episode of the Kingscrowd Podcast. My name is Brian Belley. Today, I am joined by the amazing Senior Investment Associate at Kingscrowd, Bouhelier-Gautreau. Leah is one of the analysts who looks at all of the deals, helps out with the Kingscrowd Capital Fund, and we're going to be diving into a lot of great discussions today with her. So we have two things to talk about. We're going to talk about a quick part in the news of the industry where Substack, which is a company that raised on Wefunder back in 2023 now, just announced Series C funding and what that means for investors who invested in them on the Wefunder round. Then we actually have a review of the first half of 2025 investment crowdfunding annual report. So we took a look at all of the data, the different trends, how much capital was raised, different trends in investing, and we'll be talking about some of the top platforms and different industries as well for a chart that Leah has put together. All right, let's kick things off. The first part of the discussion today, just real quick, is something we wanted to highlight for a lot of investors who potentially invested in Substack. Substack is a newsletter company that really kind of came up around the era of COVID, and they actually did an online funding round on Wefunder in 2023. So I can pull up the Kingscrowd raise page so we can take a look at it, but they just recently announced that they raised a Series C, $100 million Series C, at a valuation of 1.1 billion. So if you go to the Wefunder page for Substack, you can see this is just public. We're logged out, so they publicly announced their Series C funding. Now, this sounds great, right? Their unicorn status, typically that unicorn is a $1 billion valuation. But what does that mean? If you invest in this company, if you were one of the people who was able to invest in this because it sold out very fast, what does that mean for you? So we can do some quick math. We can go back and just take a look at what this means for investors. So in their funding round in April of 2023, you can see it was very fast. They sold out. They did, I think, a testing the waters and then almost sold out immediately. They raised the full $5 million under regulation crowdfunding that you can raise every 12 months. It was at a pre-money valuation of $585 million. Now, if I recall, this was also on the back of essentially the same terms for an Andreessen Horowitz A16Z-led round a couple months prior to their Wefunder community round. And so I think it was around a $650 million post-money valuation, if I'm remembering how much they raised or around that. We can go down here. Yeah, so we can see they raised about $82 million in prior capital. So if you add $82 million, the capital that they're raising in this round, to the pre-money valuation here, you can see it's a little bit more than call it $670 million. So let's do some quick math. This is a great place for some quick education. So let's say you invested at roughly a $670 million post-money valuation. With their new round at a $1.1 billion valuation, you can do the quick math to look at $1.1 billion over, let's say, we'll go with the $670 million. It's roughly a 64% markup. So investors have made about 64% if you do that. However, you also need to take into account dilution. So dilution here is $100 million of new capital is going into this company. So if you divide the new capital that's flowing in divided by the valuation, the post-money valuation, you get about 9% diluted. So investors saw their overall share value go up, but they do own a little bit smaller piece of the pie. So now that I've kind of geeked out and nerded out on some of the math, though, it's good news, right? For investors who invested in this round not that long ago, so, back in 2023, there were a lot of people. You can also see, it did get a 2.1 rating. And some of that is because of the price, right? So their revenues at the time to the valuation was a very high revenue multiple. But overall, good news right now. Doesn't mean that it's going to be an ultimate success in the end, but moving in the right direction. Leah, any quick comments or commentary in terms of your perspective of Substack and what this means?
Yeah, what's very interesting here is that even if Substack rated pretty low, only 2.1, it just makes sense from the perspective of algorithm, because as you say, it was overvalued. The market, we placed it into US newspaper market, even if it's, not really what it is, but it's a declining market. And in terms of differentiators, really, it's not the strength of the company. It's not really the product in itself. It's not highly differentiated. What really mattered with Substack was its performance, high traction, quick revenue growth, and the fact that the name was well known and that people were kind of flowing to use the product. So sometimes a rating does not mean that, it's not a good idea to invest in it, but then you have to make sure that the categories of the rating, so here the performance, actually matter or actually extremely good. And in the case of Substack, it's exceptional performance, exceptional traction, and great following by institutional investors that make that a business like that can still raise, because in order to dominate its market, it has to raise a lot of capital. So, but as you say, we don't know what's going to happen in the future. Competitors can still come into the market. Is that going to be a successful exit? We're on a little later, but that's why it's fun to invest in startups.
It's a great point. And, just other things to also highlight, right? They are VC backed by one of probably the most well-known VCs that are out there. That's Andreessen Horowitz. A16Z is kind of their name that they go by. But when you have really big backers like that, two things kind of happen. One is, that a VC firm like that probably has a lot of capital to be able to deploy, so that if there is a company that is doing well or that they want to double down on, there will be additional capital that they can give to keep that company, continuing with their growth. The second thing is having a huge name like A16Z makes it much easier for this company to raise capital. So I'm sure that's one of the reasons back in 2023 that so many people, now granted, a lot of the investors were the customers. That was a lot of the reason for Substack doing this round. But when an investor who is considering opportunities sees a name like Andreessen Horowitz on the cap table, it's like, okay, this company is a super well-known VC. They've had a lot of success in the past. They probably did really good diligence. They're going to follow on and typically want to invest in that company. It's at least another kind of check mark on the checklist for things when investors are looking at it. So good news for Substack. And we are going to be highlighting some more successes even prior to exits, but when they happen. So that's the first part of today's segment. All right, let's hop over, Leah, and talk about 2025, the first half of the year. So first 6 months are now in the books. We've kind of taken a look at where the investment crowdfunding industry, from both capital raising and investment volume, have been. Where we ended up in terms of the middle of the year was actually very strong growth compared to some of the most recent years. So this is an annual chart just over the past 6 years from 2020 through 2025. The bars for 2025 only show the first half. All of these other bars show the full year growth. So you can see that there was a bit of a declining investment since that 2021, COVID peak. There's been declining online investment volume. However, this year, we are actually already pretty close to the full amount that was raised under 2024. And you can also see Reg CF is in purple, so that's regulation crowdfunding. Reg A, or regulation A, is in green. So you can see Reg A had a very strong first half where it even exceeded basically all of 2023 and all of 2024 just in that first half. So if you take this and extrapolate out, over the first 6 months, if we see similar investment volume in the second half of the year, that would put us at roughly $900 million raised in capital, or dollars invested, at the end of the year, which would be 63% growth since last year. So pretty significant. Now, you could ask, what is this signifying? What does this mean? Granted, if you just go back right to a couple months ago in April of this year, the S&P 500 public stocks were almost down 20%. There was a lot of volatility around everything going on with the tariff announcements. Despite all that, right, this market still showed really robust capital raising behavior. So I think that there is a bit of the investor coming back to the private markets, seeking some of those alternative returns outside of public markets. I think that it's also very indicative that some more, I will say, maybe more mature companies are starting to raise capital, right? And some more well-known names. So that has been a trend that I think we have seen. But I'm going to pause. We could talk about a lot of these investment trends. Leah, what do you think in terms of the average and the annual investment volume here that we're taking a look at? What are your takeaways?
Well, that's very exciting. And the big question that I want us to answer today is why? Why is there that big jump? And I think you said it. It's because the Reg A market has been extremely dynamic. So if we kind of look at the latest raises that closed recently and really were just raising a lot of money, we have, for example, David, which is a movie that was raising on Dalmore Groups through Reg A. It closed in April of this year. And it raised about $55+ million. So that's already about 10% of just the first half of the year, that's definitely a lot of money. In terms of other outliers, we have Start Engine that raised $16 million as well and closed in June 2025. And we have Newsmax that raised 75 million in March. And Newsmax raise was it was open, I think, yeah, we can say that, for just a couple of weeks, less than a month. And just $75 million just flew into the market. And I really think that these deals are exciting because they bring a lot of new investors to discover equity crowdfunding as well, to be involved in the market and just kind of, well, make both the company and the platform hosting them winners.
Yeah, it's and just to be clear, so a few of the names, right, that Leah said, Start Engine, David, those are big ones. This table is only showing companies that started in 2025 and have already closed or are still active in 2025. So David, Start Engine, a few of those were in 2024, which is why they might not appear in this table for just 2025 raises, but any of the dollars that they raised in 2025 were accounted for in this report. So this basically was looking at the daily funding data across all of the platforms. So yeah, as Leah mentioned, very strong Reg A plus start to the year. This is just comparing the first 6 months of each of the following years since 2021. So you can see, Reg CF is moderate growth, about, I think, 9% increase since the prior year. Reg A has exceeded all the years, including going back to the 2021 peak already. The other thing that's, an interesting trend that we look at is investor interest in equity-based versus debt-based offerings. So when we say debt-based, we tend to refer to either debt interest, right? You get paid a certain amount of interest and or revenue share. And then equity-based investments, securities are common stock, preferred stock, safes, convertible notes, that type of thing. Now, typically this number has ranged kind of from the 5 to 10%. So this year, so far in the first half of H1, it is still consistent with that trend where the majority of the investment volume and the activity does tend to be happening in the equity markets. There's a bunch of things that you could perhaps speculate as to why that is, but it shows that a lot of the dollars and a lot of the issuers raising capital do tend more to be on the equity-based side rather than that debt or revenue-based side. Everyone can head to this article, check out this article. It has I think the 11 raises that raised more than $3 million that have started and closed or are still open in 2025 already. And then just the full year outlook and some other great data here. But another thing we want to take a look at is a chart that Leah has put together in terms of a platform breakdown over the last 12 months. So Leah, why don't you walk us through this?
Yes, so this platform actually shows the amount of money that was raised by deals that closed between early July 2024 and early July 2025. So you may have some money that was actually raised previously to that time period, maybe still in 2023, but we really want to take a look, just have a snapshot of the market. And the first thing that I really noticed, it's kind of going back to that Reg A topic, is that this trade map represents $683 million. About half of it, so $343 million, was raised through Reg A. So Reg A represents half of the snapshot of the market that we are showing right now. Another thing that is very interesting, that the media and entertainment industry really is the one that raised the most. And for someone like me, who is not really an investor in the media and entertainment industry, I'm wondering, why? And I think that there's two reasons. First, you kind of have to know what you're doing because it's a very competitive market. So if you want to invest into a studio, into a movie, you kind of need to have some insight, maybe know the product a little bit to feel whether it's going to work or not. But the second thing is that, well, we have some of these large raises. So we have Newsmax, we have David that we just mentioned previously. We also have Angel Studios that closed in September 2024 and raised $20 million in that same industry. And we have, for example, Legion AIM that raised $6 million. All of these raises, to me, they're successful because they're able to bring a lot of investors to their raise. And that's kind of normal because at the end of the day, the media and entertainment industry succeeds by having large followers. Studios need their product, whether it's their game, their videos, their movies, to be watched by a large number of people. And so if you can bring people who believe in these studios, believe in these movies, that are already fans and that maybe have an emotional connection to them, to actually put their money where their heart is, then you end up like that with the media and entertainment industry to kind of be dominating recently the amount of money that was invested online.
As you mentioned, the first thing that I notice is a lot of the biggest ones in many of these industries tend to be those broker dealer platforms that tend to have the Reg A offerings. So we're looking at Digital Offering, which did Newsmax, Dealmaker, Dalmore Group, Start Engine, Rialto. These are all broker dealers. Whereas platforms like Wefunder is a funding platform. So Wefunder typically cannot do a Reg A Plus offering. And because of that, you'll see like Equifund, Wefunder, et cetera, they are strong performers in a lot of these categories, but Reg A is just such a big number. And this goes back again to that 2025, H1 chart that we showed, where you can raise up to 75 million a year. So those raises do tend to dominate. Now, that being said, there's still a very strong showing from some of the other platforms. And Equifund is a good example of one that maybe doesn't have a lot of raises, but typically when they do an offering like a Reg CF, they raise millions of dollars for us. They tend to do pretty well. Angel funding, I'll give a shout out to as well. In terms of the media and entertainment, they tend to do very well as well with their media. They tend to do a lot of films and financing for those films. And going back to your point, like, I couldn't agree more. Just in terms of I think you get so much of that community aspect and people who support wanting to have this media exist or have this film exist, or that are familiar already with a brand that they want to support it. And so you can get really passionate backers and really passionate supporters. Whereas some of the ones, if it's a general tech startup, you might not have that same super passionate following. Doesn't mean you can't succeed, but you might not have as easy of a path in terms of just being able to engage your community, unless you do have a big community, which a lot of these do. But yeah, that was my takeaway. And just also taking a look at the industries, right? So media and entertainment, energy and resources tends to be really capital intensive, right? We know there's a lot of big Energy X and some of the different deals there. And then some of the other industries that we're looking at. So finance and insurance, real estate, transportation, healthcare, pharma, business software. I think these are not surprising to a lot of people that will look at this chart where you'll say, yep, okay, these are a lot of both very popular with investors industries, as well as industries that can use a lot of be very capital intensive, do need a lot of financing, right? If you're talking about healthcare and pharma, right, there's a lot of investment that goes into that before they actually start generating revenue. But also some good success can be found in all the other industries. So when you take a look at food and beverage, consumer goods, even alcohol, security and defense. So I think it shows pretty good separation just in terms of the diversity of the types of industries, but definitely an interesting chart. So thanks for putting it together.
So a couple of weeks ago, we took a look at the industries that were the most represented per amount of deal on equity crowdfunding platforms. So it's a different snapshot in time. It's taking the deals that started between the beginning and the end of 2024. But trends are kind of similar. And what we see here is that healthcare and pharmaceuticals, energy resources, transportation are still represented at some of the major industries. And so it's kind of understandable that they also get to raise a lot. But what we see that the media and entertainment industry is raising way more money than its deal representation within the market. And the reverse here is that the food and beverage industry is extremely represented in the market. There are a lot of deals constantly, whether it's restaurants, beverages, whether it's CPG, foods, etc. But if we go back to the previous chart, I don't even know where it is. Yeah, you go at the bottom right. So it's not really taking a big share of that money, and that's okay. I think you have to remember what are these industries made of. Food and beverage, they typically don't need a lot of money to be able to grow. They can start smallly. Sometimes they have just lower valuation. They're not that capital intensive. As long as they can get a little bit traction with their customers, it doesn't mean that they're all going to become large brands that will be adopted everywhere around the world. But you can have a good food and beverage brand that is running on a couple $1 million, is profitable. So I feel like this is kind of telling us a lot about what are the industries, what are the startups, and how much money they need.
Yeah, that's a really good comparison.
So Brian, now that you looked at the first half of 2025, what do you think are going to be the major trends for the rest of the year?
Yeah, so I think there's a couple interesting things, and I'm pulling back up the article here. So, what are some potential tailwinds between drivers that could make the market continue to perform really strongly? First, the public markets are still at all-time highs right now as we record this. It's the end of July 2025. Does not mean it's not going to, or that it couldn't continue. But right now, I think there's a lot of capital that's out there. So people's portfolios are feeling good, and they may have a little bit more of that risk-on appetite to be able to invest in some of the private markets. In addition, while it's a somewhat different kind of market, the crypto market is really providing, I think, a lot more liquidity and kind of funds and making people's portfolios feel pretty good right now. We've seen crypto, both Bitcoin and now even some of the altcoins really rallying. So that's just giving, I think, more of that risk capital appetite to some of those investors who may invest in crypto as well as some of the other alternatives. In addition, I think at this point, we're still a little bit uncertain with some of the policy around the tariffs and everything, but I think there's less uncertainty than there was earlier in the year. And if there's one thing that the markets don't like is uncertainty, right? If things are bad, at least people know it's bad. If things are good, it's good. But when there's uncertainty, I think that's when there's a lot of volatility. So now that there is a little bit more policy and clarity, and we've seen some of these acts pass recently, right? So the Genius Act, which is a stablecoin bill, got signed in. There's the Clarity Act, which is going to be looking to be passed towards the end of the year. So all of these things are going to potentially contribute to tailwinds, I think, because think of this for crypto. I know that people can be pretty polarized in terms of their perspectives on crypto and whether or not it belongs as part of like a capital formation side in terms of the market. But Reg A Plus is a very viable alternative path for crypto securities. So crypto any asset that would be treated as a security could potentially raise under Reg A Plus or Reg CF for smaller ones. And if that is a chosen path or one of the pathways that ends up becoming an accepted standard for being able to raise capital, that could lead to a lot more industry activity in terms of the Reg CF and Reg A markets. Now, what do we have on the headwind side? There's definitely still, we're in a higher interest rate environment than we have been traditionally. There is still some of that uncertainty around the crypto. So while we are getting some clarity, there is still going to be that uncertainty, and as well as just general economic uncertainty and volatility. And in addition, I think that we are also seeing the potential innovation of new financial vehicles, right? And the impact of that on the regulated securities markets like Reg CF and Reg A is still unknown. So for that, we had a podcast a couple of weeks ago where we talked about mirror tokens. Now those are being pitched as a testing the waters under Reg CF today. But I think in terms of just what that finally looks like at the end is still a little bit up in the air. In addition, I think while Newsmax's $75 million and some of the big raises you mentioned for Reg A were huge at the beginning of the year, will those be able to continue? Will we see continued success? Now, one of the things I'll mention that was in the news also this last week, I believe it was the LA Times mentioned that they're potentially going public, and there may be another Reg A Plus offering associated with that through Digital Offering, which was the platform that also did the Newsmax $75 million. So again, if we see more huge raises like that, I think it brings more awareness, more interest to some of these other forms of capital formation. But if there isn't, for whatever reason, if there's some cooling off, we could be pulling back a little bit. So that's my quick take there based on some of the things we wrote in the article. But I think it's a good place to wrap things up. So thank you everyone for joining us today. And again, feel free to head over to Kingscrowd. You can join our newsletter and you will get all these great data-driven insights delivered right to your inbox every single week. Also, feel free to check out the articles and also our podcast. Hit subscribe on this so you get the new notifications whenever a new episode goes live. And if you want to see the recorded versions, you can make sure you're checking us out on YouTube. All right, thanks everyone, and we'll see you back here next time.